is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, everyone, and welcome back to another episode of DeFi Decoded. I'm Alex Tapscott here with my co-host Andrew Young. And today's a kind of a special episode. We're going to be looking back at the just over 2 months that we've been running this podcast. And a lot has happened in that 2 months. Andrew's going to talk a little bit about some of the changes we've seen in the growth in the industry. But I think the key thing we wanted to do today is to just sort of summarize all of the different areas that we have covered through this discussion. And I'm going to use a framework that I actually developed for the book Blockchain Revolution that tries to basically break down and understand what the financial industry does. You see, the financial services industry is more than just some other industry. It is the cardiovascular system of the global economy, and it's really the lifeline of all other industries. Without the flow of funds, without access to credit and capital, industry basically ceases. And DeFi is essentially reimagining this entire anatomy, not just how the money moves around the world, but all of the other elements as well. And it's helpful to use this framework that we developed, I think, that basically breaks the industry down into 9 component parts: storing value, moving value, lending value, funding and investing, exchanging value, ensuring value, analyzing value, accounting for value, and authenticating identity. So these are the 9 things. Let's just kind of go through them really quickly. So we talked a little bit about DAO treasuries. We talked a lot about cryptoasset and token wallets. These are basically the new bank accounts for institutions and individuals respectively. So how we store value is changing. We talked about decentralized stablecoins like DAI, which is doing more volume than Venmo, and centralized stablecoins like USDC and USDT, which are some of the most liquid markets in the world. They're changing how we move money around the world. We talked about pooled lending protocols like Compound and AAVE, which have augmented savings accounts at banks and other financial intermediaries and have much better yields to boot. So how we lend money and how we borrow money is changing as well. We talked about investment aggregators like YFI, as well as DeFi index funds, which are changing how we get access to investments, different kinds of strategies, and so forth. We talked about decentralized exchanges like Uniswap, SushiSwap, and others that are changing how we exchange assets in the economy. Now, right now, it's all crypto assets, but as we discussed on one of the episodes, we think that it could eventually change how we move all sorts of different kinds of assets, including securities. So how we exchange value is changing. We talked about on-chain insurance, such as Nexus Mutual, as well as derivatives platforms like SX, Perpetual Protocol, and DYDX, which in our view could supplement or replace insurance policies and over-the-counter derivatives markets. They're being used primarily today by traders and by arbitrageurs and so forth, but the building blocks are there for a decentralized insurance and derivatives market as well. We talked about analyzing value, how we basically use contract auditors like Zeppelin or DeFi Score, which can basically do a lot of what accounting firms do. We need accounting firms to go independently verify the transactions inside of a company, but when you have a blockchain, you have a distributed public ledger that can act as a source of trusted information for all participants. We've talked a little bit about accounting. We've also talked a little bit about identity or the lack thereof, how basically these are open protocols, so you can access all of these different DeFi tools without the normal kinds of accreditation that gatekeepers like banks require. So all of these different 9 elements, in other words, of what the industry does, are being transformed by DeFi. And even though DeFi leading up to the launch of this podcast had grown tremendously, that growth has only continued. Andrew, what is your takeaway from our first, 10 episodes and what we've seen in the industry during that period of time?
Yeah, thanks, Alex. It's pretty crazy, actually, the fact that we kind of set out to create kind of an initial 9 episodes covering the major topics. And as we've been doing the episodes, we keep realizing that there's these other topics that we honestly just feel compelled to cover. And it's just the space is just so much deeper than you would think, even to people like us who are kind of in the space all the time. Like, for example, we had to talk about regulatory stuff on the special episode on the infrastructure bill, which included the crypto provision. We had to have an episode on NFTs, and we also, felt compelled to do an episode on DAOs, which wasn't really initially planned.
Yeah.
And there's even more topics that we could definitely cover as well. So I think it's interesting that the rabbit hole on DeFi is just kind of so deep that it gets really easy to sort of go in lots of directions because the space is kind of just flourishing in so many different ways. I think one thing that's also really interesting is that since we actually started the podcast, I checked the numbers, and DeFi total assets locked, according to DeFi Llama, have actually grown by 45% since we started the podcast, from around $116 billion to $167 billion today, which is, right there, that's kind of a good indicator that we're onto something with DeFi Decoded. And where do you think about, the first 2 months of DeFi Decoded?
Well, the number is amazing, especially, if you've been following the crypto asset class. I think it's probably been up during that period of time in terms of the sort of value of things like Bitcoin and Ether, but pretty modestly in comparison to the growth of DeFi, right? And I think that's sort of a very revealing figure about this industry, which is that, crypto, I think people think about cryptocurrencies, they're all currencies. They're all, designed to be, a way to move money peer-to-peer between people online. And it's true that some of them are, and that Bitcoin is the best and strongest and most valuable and most liquid version of that. There's a huge use case for that. But there are also other use cases for blockchain. And, within that blockchain sort of amorphous term are these things like DeFi, Web3, and so forth. And, I think that we can expect there to be this sort of, I don't know about bifurcation, but to see bull markets within the market happening, where DeFi, because of the fact that there's good product market fit, or NFTs because people love the idea of minting artwork, trading, selling, buying, supporting artists, being parts of communities, and so forth. That those kinds of markets are going to see lots of growth, even if the rest of the market is flat or what have you. And I think that's really interesting. One of the big trends that we've seen in the past couple of months, which we haven't talked about, is actually the rise of Ethereum, so-called Ethereum competitors. So I think for the audience, it'd just be helpful. Bitcoin really stands alone, in my opinion, as money for the internet, digital gold, and I think there's a clear role to play as a base layer for this whole digital asset ecosystem. And then there's this thing Ethereum, which is the platform for distributed applications and so forth. Ethereum is a victim of its own success in the sense that, we've talked about this, the sense that there's so many new apps and so many new users that the gas fees, essentially what you have to pay to access this stuff has gone up so much that it's making it hard for regular people to play a role. So all of these new layer ones, there's layer one, if you think of the sort of the foundation on top of which all of this stuff is built, have really exploded in size. And really, if there's any bull market that's rivaled DeFi, it's probably the bull market in layer ones that we've seen. Projects like Solana and Cosmos and Avalanche and others that have really taken off. It sort of raises an interesting question, which is, those things are succeeding because Ethereum's basically full. So doesn't that necessarily lead to the conclusion that we're going to live in this multiple platform world where all of these things are going to be running kind of at or near capacity, and really it's a function of connecting these things together? What do you think about that?
Yeah, I think that's actually a pretty fair assessment. I've always had the view that Ethereum is going to be kind of the main, the most secure blockchain, but you can't have all of these use cases on one network. Mainly because some use cases require customization. Some use cases have much lower average transaction sizes relative to others. And so naturally, they'll be priced out of the market. So for example, prediction markets, the average transaction size is around $100, which means that really the maximum that gas prices or transaction costs of using a network can really be is around 10 to 20 cents. And even that's pretty expensive. Whereas something like lending, where the average transaction size can be $50,000 or more, they are more willing, and there's also less transactions, so they don't need to do transactions every day. They can pay up to $1,000 in gas. It doesn't matter. And so I've always had the belief that it's not really we're going towards a multi-chain world, which is, and the base layer is going to be Ethereum because it's the most secure and the most kind of TVL and most highest market cap of their kind of native token. And then there's going to be these kind of alternative blockchains, we'll call them, that focus on specific use cases. And like, so for example, Solana, which has driven a ton of the growth over the last 2 months since our DeFi Decoded, they're very focused on kind of the more like higher frequency trading use case.
Right.
And on top of that, because of the lower gas costs, they've seen a pretty big rise in kind of NFTs and stuff like that. And so,
but aren't, like, just to play devil's advocate on that one, aren't low fees always better? Like, why wouldn't someone just use Solana then for everything versus Ethereum?
Yeah, so I think, well, for certain things, I think security actually trumps speed.
Oh, I see. So this is kind of back to the trilemma that we kind of talked about last time. Why don't you just rehash that for the people who are new to the show, and we can talk about that in a bit more detail.
Yeah, for sure. So essentially, there exists this blockchain trilemma, which is essentially that blockchains can only have 2 of these 3 characteristics. And the 3 characteristics are decentralization, security, and scalability. And so you can really only, networks are sort of forced to choose two of these characteristics to maximize at the expense of the third. So something like Ethereum is far more tailored to security and decentralization, and less so on scalability. Whereas something like Solana is, I mean, they kind of claim that they've solved this trilemma, but they have kind of chosen scalability, and I would say kind of security over decentralization. And so like, in the easiest way to see this is it's much harder to run sort of a Solana validator and be part of the network, providing security to the network, or like a miner, as people say, than something like Ethereum, which is sort of has lower requirements, hardware requirements, and especially so when it moves to proof of stake, in which case it's just tokens. And so yeah, so based on kind of that trilemma, there's naturally going to be different use cases that are favored. And then on top of that, the biggest thing is really community or ecosystem. So what I mean by that is certain blockchains, for example, like Flow or Palm, are specifically tailored to NFT kind of purposes. And so the community that's forming around these ecosystems is kind of passionate about this one specific use case, which to me gives it kind of a specialization advantage over more generic, one size fits all kind of blockchains. I think that's going to be the next trend, is we're going to be moving more and more towards kind of industry specific networks.
Yeah.
And the reason why is because all of the software in blockchain is actually open source for the most part. Yeah. And so technology is not really a long-term moat. Everyone kind of recognizes that community is. And what better way to maximize community by focusing on one sort of hyper-focused on one specific kind of niche.
Do these kinds of theses that you've developed inform the decisions you're making at Prophecy DeFi?
Yeah, exactly. So I think, so with what we're doing with Prophecy DeFi and actually SX Network as well, we're very focused on this sort of long-term thesis that we're heading towards fragmentation in terms of kind of the blockchain space. And I know like a lot of more like Ethereum maximalists and people like that would disagree, but to me, it's kind of natural that we're sort of heading to a space where you'll have Ethereum, which is kind of the base security layer. And then one level up, you'll have kind of layer 2s and alternative layer 1s like Solana. And then finally, like this third layer is going to be more application specific sort of chains that are typically going to be sort of built on top of either a layer 1 or layer 2. So to give you a good example, Compound announced this thing called Gateway and Compound Chain, which is a blockchain built using the Polkadot substrate sort of SDK. And it's hyper focused on the lending and borrowing use case. And to me, that is going to be, because they're so obviously specialized and one of the largest lending protocols in the world, to me, that seems like and also the way they've designed it, they can hook into all these other chains really easily. To me, that sort of specialization is going to give them a competitive advantage and give that blockchain a competitive advantage in the specific lending use case.
Right.
And that's also what we're doing at SX Network. We're hyper focused on the prediction market use case, designing sort of a public blockchain using the Polygon SDK, focused on kind of creating both a community and a network designed for that specific use case.
Yeah.
And both.
Well, it's interesting because, we talk about the different components of the financial industry and how big, DeFi has gotten in each of them. So we know that, for example, in lending, it's bigger than it is in investing, right? Index, ETF, alternatives, DeFi are smaller than the total lending market. But if you look at, the industries themselves in the real world, they are obviously, many multiples larger than that. So if you're correct, and there's going to be blockchains that are unique to specific industries or to specific, kinds of applications, and not to pigeonhole it into industry, then owning that platform is kind of like owning a piece of the base layer for that industry. So if you think about prediction markets and derivatives, SX, one of your two things that you founded, that is, today, I don't know what kind of volumes you're doing, a few $1 million here and there, but eventually it could grow into something much larger, right? Because you're talking about, derivatives market that's many orders of magnitude larger than what DeFi is today. Do you know Robert Leshner, I think is his name? He's the founder of Compound Finance. Today, I had a quote that I thought was good at this event that's happening in New York. He basically said, in 5 years' time, there's not going to be a thing called DeFi. It's just going to be called finance. And these kinds of distinctions that we're making between DeFi and what is DeFi and what isn't DeFi are going to disappear. I'm not totally convinced of that. I think that it's true that DeFi can be so big that it's integrated into the financial world, but I think it will always continue to be distinct, sort of in the same way that we talk about social media. I mean, social media is part of the whole media universe, but it is something that is distinct. It's digitally native, and I think DeFi is digitally native as well. So, we'll see how that plays out. But it seems to me like this is still very much grassroots level of what we can see as big innovation, big development in each of those different silos. Do you agree?
Yeah, for sure. To show you how early we are in this kind of in this thesis that I'm talking about, and just overall kind of this like multi-chain future that we're talking about, Ethereum dominance of DeFi, so dominance being kind of like their market share, at the end of 2020 was about 99.5%. So essentially DeFi has been on, and today it still stands at 69%.
Wow.
DeFi Llama. So the DeFi on, or even just activity on non-Ethereum chains was essentially zero until really this year, started this year. And since then, things have, and that's actually been driving a lot of the growth on DeFi generally, is just the kind of proliferation of these new chains. The biggest one right now being Binance, but increasingly Solana, Terra Luna, and Polygon. And then on top of that, there's been a number of initiatives to sort of break into the market share of both Ethereum and these other competitors. And you're seeing things like these massive blockchain liquidity mining programs being announced. So for example, Phantom, which is a top 10 blockchain, but sort of outside of the top 5, they announced, I believe it was around a $300 million liquidity mining program. So what I mean by that is the blockchain itself is essentially issuing rewards to people that participate in phantom-related DeFi protocols. Avalanche also just announced a $180 million liquidity mine program, and their DeFi ecosystem essentially tripled overnight. And so what's increasingly happening is you're having this kind of arms race between these non-Ethereum chains to sort of elbow their way into contention, I guess, what you can call it, through the use of just kind of dramatic liquidity mining incentives, which is kind of just like a subsidy for people to use their sort of ecosystems products. And I think we're actually just at the start of that, rather than sort of the end, because kind of as of today, there's only really 5 or 6 kind of blockchains that have kind of over $1 billion of TVL, which is sort of like the minimum level, I would say. And only kind of 20 blockchains total that have over $100 million of TVL, which is quite a little amount. So I think we're going to see kind of increasingly sort of more chains coming online with sort of larger and larger liquidity mining incentives.
That's amazing. The idea basically that you get subsidized at the outset to help bootstrap the network creates a pretty strong incentive. It's almost like, and by the way, like subsidizing growth is not something that's that's unique to DeFi. That's actually been the Silicon Valley model for many years. Uber, for example, when you got an Uber last year, 2 years ago, it was pretty cheap because they were subsidizing, the growth. Nowadays, you get in an Uber, it's twice as much as a taxi. I just FYI, if you've gotten an Uber recently, that's the case. But it's different in the sense that, imagine with the Uber example, instead of getting $5 knocked off your ride or something, by being a driver or even a rider in Uber in the early days, you were actually earning a piece of the network. That's effectively what's happening with these liquidity mining programs. Like you are being subsidized and you're earning the native token for that application or that blockchain. Which again, like you apply these models to the traditional world, you can imagine a DAO that does ride sharing, for example, connecting people and drivers and giving people an incentive to pool their resources and use rides. It's actually something we talked about in Blockchain Revolution, but never really happened. I think maybe because, the underlying technology just wasn't there. I mean, at the time we wrote this, there was Bitcoin and Ethereum had launched, but there were no dApps and there was no real user base, and it seemed all kind of a little out there. Nowadays, I think something like that could work. So you think about these models and how they apply to other industries, it starts to get the wheels turning. In terms of, the next few episodes, you mentioned that every time we do an episode, we think of another topic. So we are going to get around to interviewing people, but there are other topics we want to dig into. I think what we'll do is kind of alternate a little bit, but also if we can find someone who, can talk to this new idea we haven't discussed yet, then that's the best of both worlds. So do stay tuned. There's going to be a lot more really great stuff coming your way on DeFi Decoded. All of this can be found, by the way, on YouTube. You can find this podcast wherever you get them, iTunes, Spotify, etc. Check us out online. You can follow both me and Andrew on Twitter for our sort of insights in the space and the market in between episodes. And send us your questions if you have any. We're happy to integrate any ideas from the audience into the discussion. So thanks for tuning in. This has been another episode of DeFi Decoded. I'm Alex, here with my co-host Andrew, and we wish you all a great day. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.